So I'll make a start. I think we'll let a couple of people come in as well. There we go. Great, so yeah, thank you everyone for coming. It's a great pleasure to be part of such an amazing event like this. I need to be Hopperx1. But I'm going to start off today's session by asking for some audience participation, if that's okay. So if you could please raise your hand if you have ever applied for a mortgage. That's me. And keep your hands raised. So now if you've ever applied for a credit card. Lots of people. Finally, if you have ever taken out a mobile phone contract, which is most people in the room. So what you all have in common is that at some point in your recent past, you have been assessed for your creditworthiness. And that's the topic of today's talk, is credit scoring and how we understand the models that are used for that creditworthiness assessment. So I'll start with a brief history of credit scoring. I'll go through some examples of how that's evolved from quite a human-led decision to a more machine-led. And then true back to some important considerations that are still important for the past, the present, and the future of credit scoring. First, a little bit about me. I'm Heather Hackett. I work for Capital One. My history, I guess, is quite traditional statistics background, so maths and stats at university. I did a PhD in image analysis, quantifying lung fibrosis from CT scans. And then I joined Capital One data science team around 5 years ago, where I brought this kind of statistical knowledge basis into the world of credit scoring. A little bit about Capital One as well. So you might know us as a credit card company in the UK, where we have around 3 million customers. Oh, this has changed. Yep, that's 3 million customers on our book. You might not know that we are a big bank in the US, one of the top 10. We have a full spectrum of products, so car loans, mortgages, all sorts. In the UK, our data science team is around 20 people, and in tech, I think we have around 500-ish people across Nottingham and London. And we're also known for being innovative with our technology and our data. So most of you have experienced credit scoring, but we're going to go back to where it all began. So we're going to pop into our time machine and travel back to the early 20th century. We'll stop in at 1920 and meet Joan and John, who are applying for a mortgage for their first home together. So they will go into their local bank, building society, and sit down with their bank manager, let's call him Mr. Smith, and Mr. Smith will make an assessment about how likely he thinks Joan and John are to repay that mortgage loan. He'll ask them for some information, such as their jobs, their salary, their housing situation. And he might have some financial history about them from their accounts that they currently hold with that bank or from other banks, but he won't have a full picture of their credit history. And he might also make some judgments based on character or demographics. And also, Mr. Smith's decision about Joan and John might be quite different to his colleague, Mr. Roberts. So Joan and John experience quite a subjective creditworthiness assessment that is inconsistent from one assessor to the next. And actually, that was the case from when lending as a concept first began, right up until the 1980s in the UK. It's slightly earlier in the US. So we're going to hop forward in our time machine now to, let's say, 1985, and we'll meet Jeanette. Jeanette is applying for a credit card. And so she will likely still go into her bank and sit down with her bank manager. Let's call her Mrs. Jones. But Mrs. Jones will use a tool such as a scorecard. So she'll collect that information from Jeanette. So say Jeanette's been in her job for 2 years. So we start off with a score of 20. She rents her home, so we add 19. She has both checkings and savings accounts. We add 31. Etc., until we have built up Jeanette's credit score. You'll notice at the bottom here, credit reference credit reference row, which is information from Jeanette's credit file from the credit reference agencies. So in the UK, the three main ones here are Equifax, Experian, TransUnion. But when Mrs. Jones, the bank manager, goes to the credit reference agency to request this information, that process of requesting and receiving that credit file can take days. It can take a few days back in this day. So although Jeanette's creditworthiness is very much a quantitative measure that only uses relevant information, so we're not using character judgment here anymore, but it can take a few days to get that decision. So when we think about how do we know to add 40 points to homeowners? Well, this whole scorecard is, even back in the 80s, is developed using statistical modelling. And so how do we go about building such a model? We use information that we have about previous customers to make a prediction about a future customer's outcome. So an outcome that is typical for credit risk modelling might be whether someone defaults on their payments in the 12 months between opening the account and 12 months later. And so here we've just got a couple of examples of some of those possible outcomes that we might see for customers. So they might default on their payments in that 12-month period, which is a bad outcome for the customer and for us. They might close their account on good terms in that period. So they've paid off all their balances and closed the account. Still a good outcome for us and the customer. They might have been declined at the point of application. So we don't actually have any data about their outcome 12 months later because they never became an account, never opened an account with us. Or they might still have their card open and still be making transactions and making payments on it still in a good status. So what we're trying to do with credit risk modelling is find the best way of describing the relationship between what we know at the point where someone applies using the application data and what their outcome will be 12 months later in this case. And one method that has been used since the 80s in credit scoring and is still used in some companies today is logistic regression, which is a valid machine learning technique, although so we'll come on to some of those different things. What we're doing here is trying to find the best way of describing the relationship between that application data, so the X's, and the outcome, where we're constraining that relationship to take this form. And the reason why logistic regression has been popular in credit scoring and as a general classification method is that we have very efficient algorithms for finding the best beta values here to describe that relationship. And once we've fitted the model, so once we've fixed this equation, it's quite easy and straightforward to calculate that prediction for any new customer that is applying for a credit card. So we enter that new applicant's information and we get out a prediction. It's a single equation. But let's jump forward back into our time machine and come back to present day. So here we have Jessica back in 2019. And Jessica will likely apply for her credit card online. But a couple of things have changed in addition to the way she applies since the 80s. One of them being that we now have the direct connection to the credit reference agencies. So we ask for Jessica's credit file and we get that returned in milliseconds. So we can provide Jessica with an instant result of her application. And also, the other thing that's changed is compute power. So we're now able to build much more computationally intensive machine learning models, which provide a superior assessment of somebody's creditworthiness. And just one example, there are many of machine learning algorithms that we could use here. One being gradient boosting machines, so GBMs. So GBMs are essentially a set of weak prediction models that together form one strong prediction model, also known as an ensemble of models. And one GBM could be thousands of smaller prediction models. we're still using the same application data and we're still predicting the same outcome, but we've removed that constraint of the relationship between the application data and their outcome 12 months later. So we can now have much more non-linear relationships in that model, and there could be interactions between the variables in that model as well. And once we've fitted this model, so once we've fixed this structure, to score a new applicant through that model can require hundreds of thousands of these partitions being calculated for any one application. So it's computationally intensive to build and to actually score through in our live environment. But we have that computing power in our infrastructure today. There are some things that we need to consider that apply to every example that we've explored here in creditworthiness. And I'm just going to touch on a couple, mainly from perspectives of building robust models and building fair models. So we need to make sure that, so we've built a model, we need to make sure it's going to be good at predicting what it's set out to for new customers. And so one problem that we might encounter is that we build that model on a set of previous customers, but a new customer might have a value that the model hasn't seen before. So say Jessica earns 90K salary, go Jessica. But in our build data, the maximum income that was in any of our customer bases was 85K. We need to make sure we understand what the model is going to do with that value, and so that we're making sure that we're not extrapolating any of those relationships beyond what we've seen before. And that could be done by some pre-processing of that data. Is the model appropriate for a new population? So say our model is built using credit card customers, but we want to, we need a model, we're looking to expand into a different type of financial product, say loans. We need to make sure that that model is still appropriate for predicting the likelihood that someone's going to default on that type of financial product, not just on credit cards. How well is that model predicting that outcome over time? So a number of reasons why a model might degrade over time. It could be that the relationships between that application data and the outcome is changing, or there's some relationship between the input variables themselves that's changing. It could be that there's something else in the economic environment that is affecting somebody's likelihood that they're going to default on that payment. So how do we deal with that? We don't have to wait 12 months to be able to find out whether there's something coming that is going to impact our models. We can look at the distributions of those variables going into the model, those pieces of information going into the model, to see is there anything changing early on. So we can look at that from, as in real time as those applications come in, to see if there's anything changing in the things that are feeding into our model that are going to impact it later on down the line. And we can also look for gaps between where our model isn't predicting the outcome. So we can look at that from the perspective of, are there any other factors that are available, any other pieces of information that aren't included in our model that can help us to explain what's not being captured by the model. And we have a couple of tools that help us with this thought process. So at Capital One, we are big on our model governance. And we have model policy, which is a tool to really ensure that we consider the risks from each of these perspectives, and that we provide evidence of that and document it in a centralized location. We also, from a people perspective, when thinking about standardization and automation of our model developing frameworks, it's more about can we build processes and frameworks that are consistent and reproducible to make it easier to be able to consider these things and not have that focus on have code review of my model development framework. And are the people who are building the models well informed about the techniques that they're using? Do we understand exactly what is going on in the different machine learning algorithms? Do we know what hyperparameters we need to consider for building these models? And then thinking about how fair those decisions are, how well do we understand the model? So primarily, how well do we understand the data? Are we confident in the lineage of that data? Do we know where it's come from? Are we happy with the data quality? Are there any known issues for any part of that development data? And do we know what each of those pieces of data mean? Are we happy using that information to make a decision about whether to offer somebody a credit card or give them a credit limit increase and things like that? So then how do we understand the relationships within the model? And this is something that gets increasingly difficult the more complex the structure of those machine learning models is. It's in the logistic regression world, it is that bit easier to visualize relationships between the app data, the application data, and the outcomes. In a GBM world where those relationships are non-linear and there's potentially interactions between the data going in there, it's a lot more difficult to visualize that and to understand exactly what's going on. There's a couple of tools that we use, like partial dependence plots and ALE plots, ALE plots, that help us to visualize those relationships. Also, once we have tried to understand these relationships, how do they feed into our downstream processes? And I'm going to give an example of utilization. So this is how much balance has somebody spent on their credit card compared to how much credit limit they have. What we can often see is that people who have gone over their credit limit, spent over their credit limit, can look lower risk, which at first thought you think that's a slightly odd thing going on there, that somebody has spent over their credit limit, they look lower risk. But when you dive into it, it's because there are other credit providers, whether that's us or another credit provider, has needed to make a decision when that person is called in to request a transaction to be allowed, to allow them to go over their credit limit. The lender will look at that person and say, based on their other financial history, do I think they're low enough risk to be able to go over their credit limit? So it's only those people who are low enough risk to be able to go over their credit limit are allowed to by those other lenders. So this is a slightly odd relationship. When it comes to understanding that in terms of the downstream processes of our decisioning ecosystem, we don't want to be making a decision to say, those people who have gone over their credit limit, we're going to further extend their credit limit. It's not a decision that we want to do when we're thinking about that in the whole customer journey life cycle. So we have met Joan and John, who experienced quite a subjective and inconsistent creditworthiness assessment. Jeanette, whose credit score was a statistically derived model that was used there, but she had to wait a few days to get that decision. And we ended up with Jessica in our present day, who gets that instant decision about whether she's going to be accepted for that credit card. And we're using superior credit risk modelling techniques, so she gets a much better, more accurate assessment of her credit worthiness. And just to reiterate, it's still really important in any of these three approaches to really think about how robust and how fair those models are. Cool, thank you. I think that is... We've got 5 minutes. If there's any questions, or otherwise I'll go hang out by the Capital One stand for the rest of the afternoon, if you'd like to catch me there.